IFW Retirement Roadmap Webinar on Demand. Let's get right into the agenda. We're going to talk about a few really critical things, all encompassed in something we call the IFW Retirement Roadmap. This roadmap shows you exactly what you need to do in order to make sure that, number one, we can lower taxes or maybe even eliminate them in retirement. The second thing the roadmap can show us is how we mitigate the effects of market volatility on your portfolio, especially as you near retirement. And third, and maybe the most important, are different strategies that we can use within the context of this roadmap that can ensure that you never run out of money. Before we start speaking about all these tax strategies, let's focus on a little bit of background on the American tax history. So the tax was, the U.S. income tax was founded in 1913, and it was supposed to be a temporary thing, but obviously it's alive and growing strong. The tax history, we're in the lowest tax rate environment that we've ever been in the history of our country. There were times in the 60s, 70s, 80s, taxes were as high as 90%. Matter of fact, that's one of the reasons that Ronald Reagan was so passionate about lower taxes, because he was disincented to do more movies, because when he did more movies, he would end up only keeping 10% of the revenue. And that's why he went into this whole theory on Reaganomics and so forth. But while it's good that taxes are the lowest they've ever been, the challenge with that is that our debt is the highest that it's ever been in the history of our country. And most people think, and I agree, it's just not sustainable. So what are the ramifications of this high debt and this low taxes? Number one, the only way out of this, the way I see it, and many, many other financial analysts and advisors, is that at some point we're going to have to raise taxes. So it's very important to keep in mind as you plan in the future, if tax rates are going up, we have to take that into consideration as we plan, especially when it comes to our qualified plans, all those pre-tax type of retirement programs. The second thing is about our debt limit. Now, in order for us to continue to attract money to our country, if our debt is higher and higher, people are going to have less and less confidence about this great backing of the U.S. government. And we may have to raise rates so that treasury bills and money markets and things like that pay a higher interest rate. And if we do that, imagine, and I'm not saying this is going to happen, but just imagine for a second that you could get 8% in a money market. Do you really believe that the stock market is not going to have a big withdrawal from it and potentially go down? That's just one of the possibilities of why the stock market could go down. And there's a lot of reasons. One big reason is just it's been up since 2008, and at some point there's got to be a correction, and nobody knows exactly when. The key is that if it happens to you when you're in your early years of retirement, it could be a bit of a challenge. So we want to take those things into consideration as we explore the history and the potential future of U.S. tax history. So now let's talk about the fun stuff, okay? If that's the environment that we're in, which is basically a likely scenario where tax rates go up, what about this thing called the Tax Cuts and Jobs Act of 2017? Part of that legislation enabled us to do what's called a Roth IRA conversion. Now, what exactly does that mean? Well, it means that we take a traditional IRA or a 401k or a 403b, something that's grown without any tax ever being paid, and we're going to pay the tax when we withdraw the money. So let's imagine, I'm a numbers guy, so I always like to use numbers. So imagine we have $10,000 and we pay tax now on that money. We pay $2,000 because we're in a 20% tax rate. Now, what if we leave it there? But now the $10,000 inside this retirement account grows to $30,000 or $40,000 over the next 10, 15 years. And now all of a sudden that $10,000 is, let's make believe it's $30,000. But now tax rates have gone up because of what I mentioned before about debt. And now that 20% tax rate that we were in is now a 30% tax rate. Well, now instead of paying $2,000 in taxes on that $10,000, we have $30,000 we pay 30% on, which is $9,000. What would you rather pay tax on? $2,000 tax or $9,000 tax? The answer is obvious. And that's a reason why this conversion of the Roth IRA may make sense for many of us. Because if tax rates go up, the Roth conversion in essence is paying the tax now for tax-free distributions later. That is in essence what the Roth conversion can do for you. But there's more. There's something called provisional income. Now, provisional income is nothing more than a fancy way of saying what income counts to determine whether or not my Social Security is taxable. And if you have income greater than $44,000 if you're married, or if you have income greater than, I think, $32,000 if I'm single, then 85% of your Social Security will be taxed. That's if your provisional income is greater than those numbers. Now, what if certain income didn't count for provisional income? For example, the Roth income. So if we have $100,000 a year coming in inside from a Roth IRA, that $100,000 is zero in terms of provisional income. But if we have $100,000 a year coming out of a traditional IRA, that's 100% provisional income. So just by flipping it from a traditional to a Roth IRA, not only could we potentially pay lower taxes because of tax rates, but our Social Security could not be taxable at all if all of our money is coming out of Roth IRAs and things like Roth IRAs. It's a very, very big opportunity, so that if we can get our audience members to be at 67 years old, receiving their Social Security, but having all their income coming from Roth IRAs, they're going to be so much better off. Another great product when it comes to tax planning is an HSA, a health savings account. What's great about this product is it enables you to deduct as high as $8,200. If you're a married couple older than 55 years old, you can actually put $8,200 away, deduct it off your tax return. It'll accumulate without being taxed, and you can actually access the money completely tax-free if you use it for eligible healthcare expenses. This could be a tremendous advantage. And many of you are thinking maybe, well, what if I don't use it for medical expenses? Do I lose it? The answer is no. As long as you're after post 65 years old, you can use it for retirement money. You would have to pay taxes at that point, but lo and behold, you would not be penalized in terms of getting zero access to the money. So now it's my favorite topic, which is mitigating market volatility. I've been in the business for many, many years, and I didn't learn this till I was in the business for like 5 or 10 years, around 7 years. But what this does is it shows us the difference when you're accumulating money versus distributing money. So many of you on the webinar, you've been accumulating money for some time now. And when you're accumulating the money, the order of your returns doesn't matter. However, when you're distributing money, it does, and we'll talk about that in a second. But as I always say, I love to look at numbers, so let's take an analysis. If we have $2 million, now don't pay attention to the number. It could be $200,000, $2 million. It's the concept that I want everybody to get familiar with. So if I have $2 million and I earn over the next 15 years an average of 11.31%, my $2 million will grow to over $8.1 million. $2 million becomes $8 million plus, averaging 11.31. Now, even though the beginning years were negative, as our financial advisors always tell us, when we're accumulating money and we have a long period of time, let it be alone. More than likely, it'll come back. And that's what happened in this scenario on the left. 2 million grew to 8 million. We had ups and downs, but we had negative years in the beginning, okay? But now let's flip to the right. We have negative years, same exact 11.31%, but the negative years come at the end, and the beginning years are really, really positive. All we did is just flip the order of returns. And the $2 million, once again, grows to 8.1 million and change. So the point of this is, as I illustrated and as I mentioned, when you're in accumulation, So let's just make believe you're in your 40s or early 50s. You're still accumulating money. The order of those returns doesn't matter. However, when we start distributing our money, the order of returns matters a lot. And so many of you, as I mentioned before, you're getting to a place where you're nearing retirement. You're nearing the place where you're going to be distributing some of this money. So as we look to the left, again, we show the same scenario, the $2 million, the same rates of return at the beginning, being negative in the beginning and positive at the end. And what happens? Because we did poorly in the beginning, we actually ran out of money in the 12th year. I want to remind you, we're only pulling out 10%, 200,000, but we averaged 11.31%. The bad news is that the order, we did poorly in the beginning. So if you do poorly at the beginning of your retirement, the beginning of the time you're going to distribute money, it could really cause you to run out of money, and that's what we don't want. This story, this situation reminds me of a story about a really, really good childhood friend of mine whose parents retired in 2007. And everybody knows what happened in 2008. Their first year of retirement, their accounts were down almost 40%, but they had no choice but to use some of that money. So they were the example on the left, distributing money in a very, very down market. And it's 13 years later now, and guess what? They are just about only living on Social Security. They didn't die before they ran out of money. Their money ran out before them. This is a situation we want to avoid. Now, there's a concept in finance, it's a fancy term called a volatility buffer. I'm going to simply call that a safe bucket that can't go down, that you can withdraw from even in times when the markets are down. So let's take an example of the person on the left, my friend's parents. What if, when the markets were down, they had another part of their portfolio, the safe bucket, the volatility buffer, that they could withdraw from so that they could allow their money to recoup and replenish itself and only take them? Well, there was 4 years, and as we look at this chart, there was 4 years where the market was down. So if we didn't distribute during those 4 years out of 15, we end up not running out of money. As a matter of fact, we have $2.1 million left at the end of 15 years. Now you might be saying, well, you didn't get as much income, and that's true. There's $800,000 that we took from another bucket, that safe bucket, that volatility buffer. But even if we subtract $800,000, we still have $1.3 million left, whereas in the previous situation, we were out of money in the 12th year. So this concept of the volatility buffer is a very, very critical strategy, and everybody that's in the distribution phase of their life, if there's anything that you get from this webinar on demand, please make sure that you have your assets set up in a way where if the markets are down, you have a safe bucket to withdraw from. Now, why is this so important? And the importance of never running out of money, why is it so important these days? Well, historically, we all know that most people used to retire at 62 or 65, right? They would live to 70, 72. That was the normal life expectancy, 30 years ago. And many people had company-sponsored pension plans, they had Social Security, and all those things were well-funded and healthy, and they could sustain people spending 7 to 10 years in retirement. But things have changed. Because of modern medicine, people are now living 25 to 30 years instead of 10 years. Social Security can't afford those payments. That's why you hear so many problems about Social Security. Corporate-sponsored pension plans that have basically disappeared. 85% of companies used to offer defined benefit plans. Now it's like 5 or 10%. So as this chart indicates here, if you're a 65-year-old couple today, married, you have a 66% chance that one of you will live till you're 90 years old. So there's a 66% chance that one of the two of you will live 25 years in retirement. It's so important to have these proper strategies to make sure that we're not going to run out, because we don't want our money to run out before we do. So this brings me to the roadmap, the IFW retirement roadmap that everybody that's participating and watching this webinar is going to be able to get for free, complimentary. And we'll talk about that later. But let's talk about what it does before we talk about how to get it. What it does for you is it really clearly delineates year by year, asset by asset, month by month, Social Security, any pension that you might have, IRAs, Roth IRAs, non-qualified brokerage accounts. It puts all these assets together and it delineates whether or not we're going to run out of money in retirement, or on a better note, how much of a cushion we'll be left with at age 100. Okay, so this is an example here. This person is 10 years from now has $666,000 left. They were retiring with $1 million and they needed $60,000 a year. This is a real live audience member that went through the process. The nice thing is, in this person's situation, their current plan showed $457,000 left at age 100. And it showed how much tax he was going to have to pay over the course of his life, how much Social Security tax. It was a real important exercise for this person. But the better part of it is, well, great, when we take a look at our current situation, is there an opportunity to improve it? And we're going to talk about this more, but as you get a guided review by one of the IFW financial professionals, the whole idea of the roadmap is to potentially improve your situation by incorporating some of the ideas that I shared previously. If we incorporate an HSA, if we incorporate a volatility buffer, if we incorporate a Roth conversion, how will we be better positioned? So I showed the summary of the roadmap, but now if we need to, those of you that are very technical, analytical, this roadmap is going to give you the ability to take a deeper dive and really analyze the numbers. I know you can't read those exact numbers, but it shows you how we blew up the age 100 and we show the $457,000. So in addition to the summary on the roadmap, we give a full detailed analysis for those of you that like to know how the watch was made. Now I'm going to take a minute and I just want to show you about a minute's worth of videos from prior IFW audience members that went through the retirement roadmap experience. Let's take a look.
Well, as a businessman, I always have a plan. But what I like about this financial roadmap, it lets me do what I have to do, and it's my personal GPS to my future and savings and security.
I thought the roadmap was really helpful because I'm a visual learner, and having it all laid out in front of me gave me a lot of clarity and confidence. I now know what steps I'm going to go through as I prepare for retirement.
It helped me relax because presenting me with a roadmap gave me the instructions and the confidence that I will have a financial future and I won't run out of money, and that I can actually relax and enjoy my retirement.
Before attending the webinar, we were feeling really insecure about our future and the decisions that we were making for our retirement.
Yeah, sure, but once we went to the webinar
and got our roadmap and met with our IFW financial professional, we just feel so relieved and have so much peace of mind that we can retire comfortably, securely, and have money left over to leave our family.
we might not even have to pay taxes.
That would be awesome.
Let's talk now about next steps. You've heard from, you saw a couple of wonderful, in my opinion, wonderful strategies and techniques that can help you lower or eliminate taxes in retirement, mitigate the effects of market volatility, make sure you never run out of money. We went through some great strategies and we talked about how they're encompassed in this roadmap, but everybody's situation is different, and it's important that this roadmap is customized for each and every individual. So we offer a free complimentary experience where we deliver a current roadmap to everybody that participates in our webinars on demand, our live webinars, and we make this a very delightful experience. So let's talk about how do you get your free custom retirement roadmap. The first thing you can do is you can click on the link below walk through the steps. It's really, really easy, and just simply schedule a time. Now, what can you expect when you schedule? Number one, you're going to get a concierge to meet with you for a brief introductory call. Don't be concerned about credit cards numbers. Don't be concerned about social security numbers, account numbers. We don't want any of your delicate information. We realize that it's very sensitive this day and age. At the conclusion of the call, they're going to have gathered lots of information in order to prepare your custom roadmap. They're going to want to know your account values, pre-tax, after-tax, where is the money allocated between stocks, bonds, and cash. And they're going to want to know how much you want to retire on, what age you want to retire. And that will help the concierge work with the IFW and deliver a roadmap for each and every one of you that's custom designed for your situation. After that, they're going to schedule a meeting with a financial professional that you select. And you're going to schedule a Zoom meeting with this financial professional that comes out of the IFW Financial Professional Network. So this entire roadmap process and experience is 100% confidential. But we really want to make sure that we set proper expectations for you. What you can expect is that you've all heard of the rule of 80 and 20, the 80% rule, the 20% rule. 20% of the people that go through this roadmap experience are going to receive a pat on the back. They're going to be told they're doing everything right. And there's really virtually nothing that the financial professional is going to be able to do to improve their situation. That's 20% of the time. And I liken that to go to the doctor, get your checkup, and make sure you're on track. And if you are, you get a good visit, you revisit in another year or two, and you're in good health and you get a good score. That's going to happen 20% of the time. 80% of the time, we have so much confidence in our roadmap that we're going to be able to identify areas where the financial professional can improve your situation. The only thing we ask is that you're upfront, and if the financial professional can be a member of your financial team, if they are able to help you, that's their goal. They want to become a member of your financial team. They're not looking to replace and change everything and all that. They want to add some value if they can and be a part of your team. Now, a lot of you probably have questions, and during our live webinar, we go through a big Q&A. It takes about 30 minutes, and we field questions from all over America. We combined a lot of those questions, and if you scroll down below, you can see there's a lot of frequently asked questions, and you can peruse those at your convenience. This experience, we hope you've enjoyed watching the IFW Retirement Webinar on Demand. We're looking forward to delivering your custom IFW retirement roadmap. And in 80% of the opportunities of people that get roadmaps, we are really hoping that we can improve your situation. We're looking forward to continuing the conversation with you. It's going to be fantastic.